This is the Kendall Report for Monday, March 16th, 2020. Welcome, everyone. This is Bob Kendall. We've got a lot to talk about. Just a couple mentions that we have the Fed drops rates to zero on a Sunday. They announced a huge QE program. But before we get into that, there's some realities of this situation that I think you need to understand. The global economies have hit an air pocket. I've been talking for weeks about the lack of liquidity. Well, it has just gotten worse, much worse than you can even imagine. We basically are experiencing a de facto economic shutdown and lockdowns, and this strategy is growing across the country. I talked about several videos ago that this started in China. This was the Chinese response to the virus, and everybody is adopting the Chinese model, which ultimately gets you to martial law. There were rumors around earlier today that President Trump was going to announce martial law. As far as I know, it didn't happen. It's about midnight Eastern time right now while I'm doing this broadcast, and I don't see anything on the news lines anyway. We came into this Black Swan event. It's a classic setup for something big to happen. Everything was at an extreme valuation. The markets were somewhat overvalued. Nobody was looking at debt. Nobody was paying attention to anything. It was just, let's go forward and everything's fine. It's going to be fine forever. All the technical, everything showed that this was the case. When this coronavirus thing started, you saw the markets take a catastrophic view of what's going on. I've been talking about for days the dislocation of capital. Well, the first dislocation started in China when they shut everything down, and manufacturing and the economy was shutting down, and the government started doing to supply money into the Chinese economy. We saw it go to South Korea, then to Japan, and then to Europe, and then finally here home in the U.S. And I have to say, any student of financial history in this country knows that these types of events come in multiple shock waves. And we're just seeing another shock wave. If you thought that Friday's big rally up 9%, you take a deep breath, you're a passive investor, you're not out of the hot water yet. There's more to come. This thing is just getting started. So when you get this type of response by the Federal Reserve, especially after hours activity on a weekend, on a Sunday to announce everything they did, many of these shock waves are going to be like spillover events. And spillovers are not necessarily related to the financial markets like a coronavirus. By the shutdown that the governments are taking across the world, this is unprecedented because the numbers aren't that big, okay? Maybe they know something we don't. I know there are people on both sides of this equation that believe this thing is going to go exponential and this hockey stick advance is going to happen in this virus. See people panicking, of all things, buying toilet paper and paper goods. But the attitude that's being generated is because of the actions of the governments and bringing in this element of fear. The bad news is that the spillover events actually reinforce each other, and it just kind of starts to feed on one after another, and these events get bigger and bigger. And the markets start to take the worst case assumption, but this could send us all the way back to the 2002 highs, and we'll talk about some percentages and what all that means. Before I discuss what the Fed actions they took today and what they mean for us, I just want you to understand that I've been talking about this dislocation of capital for several days now, and this action by the Fed actually confirms that that's what's going on. They're seeing massive dislocations of capital, illiquidity starting to pop up. The banking system has to be right on the edge. So let's go ahead and talk about the events that happened today. So Fed drops rates to zero. That's easy to figure out. Okay, they dropped those. The biggest thing they did today, and we can talk about the QE program, 700 billion. I was talking to somebody earlier today, and I told them, I said, well, they're going to have to do something like TARP, like a $700 billion number. That's exactly, they chose the same number that they did in 2008, 9 in that crisis. But the point is, they understand that the environment it has become very illiquid very quickly, and that's why they're stepping up to do this. As far as solving the issue, it's not a vaccine, so that's not going to do anything. So all this is very negative, but let's talk about the one positive, and I've discussed this before. When this thing's over, and it will be over, whether it ever grows to the numbers that's projected by some groups, or if it just kind of rounds off like the coronavirus White House team is talking about, they're trying to flatten off the curve. If that happens, then that's a good thing. And we'll never know whether the actions they took or the reasons that the coronavirus didn't get and spike. We'll never know if the banking system could have worked out things themselves if the Fed and the government hadn't stepped in to bail them out. We'll never know that because they bailed them out, so we don't know. It's the same thing here. They're stepping up and doing all these drastic measures. It doesn't pass the smell test. And I talked about this on the broadcast earlier, but everything that has happened in the past, we can go way back to 1987, the 89 mini crash. We can go through every major crisis event that's happened in the markets that have caused 20 and 40% declines. And all of them made sense. You could go put a finger on what's going on. This one, numbers don't add up. The response doesn't add up. So it's just a very difficult situation to reconcile. But the bottom line is what does add up is the market's reaction. And like I said earlier in this commentary, is that it is important to understand that there's going to be multiple shock waves. This thing is not over. We have, I've talked about this before, but when the earnings come out, start in April and May, about a month from now, you're going to start seeing analysts talk about different things. They're going to be talking about not earnings compression. They're going to be talking about negative earnings. I've been hearing about the potential for the GDP to possibly decline in Q2 this quarter as much as 2 to 5%. We're going to have negative GDP. There's no way to estimate what these lockdowns, shutdowns of industries are going to do to the economy. And there's no way to estimate, no matter what kind of money they throw at it, how it's going to recover. And it's going to be as bad as 2008 with a minimum, but most likely this is putting us into a 2 to 3 year plus situation that we're going to see these markets have to work out a lot of things. We've all been worried about the debt for ever and ever. We've ignored it. Now it's, as I've talked about in several videos now, that is front and center. It's all about debt, the national debt. There could be question marks come in whether the U.S. is going to be able to pay their debt. We're seeing some downtick in the treasuries after this massive action. But the bottom line is on Friday, the Fed came in and had an action that should have taken interest rates down, and they shot up. They went almost back to 1%. It's going to be very volatile this week. No way to estimate what we're going to see. We're just going to have to work with it. And I'll just say this in closing, is that it is important to understand that you should not have clients exposed in this stuff. If you are exposed, the stick your head in the sand mode probably isn't going to be a good thing. Maybe the markets rebound, but the volatility is so high. This is ridiculous to have clients exposed to this. And for the most part, should have been out weeks ago. The first gap down that we had was, that was the point where obviously you should have got out for at least after that week. Our models kicked out after the gap down. We got a big tranche of sells. I'll show you in a minute. We got another big tranche of sells. We're already into that crisis mode down below 20 percentile long, and you'll see everything here in a minute. But it's important to understand that this implosion of the markets does not get fixed easily. This will take not months, but most likely years to repair this, because there's no way to tell right now how long things are going to be shut down. This could throw our economy into a complete depression. This is the stuff that people have been talking about and writing about for years and years. And for those of you that are watching this that are in the advisory community, just know that everything will change going forward. Everybody's role is going to change. And I'm going to stay on this rant for a minute because it's also important, and I'm going to point this out in the rest of this broadcast, that one of the things that needs to be watched very closely are all of the custodians that are holding the money. The Charles Schwabs, the TD stocks that are still trading, the LPLs, any bank that is a custodian for securities needs to be watched. In 1987, the risk was in the clearinghouses. In 2008 and 9, the risk was in the banks. This time, the risk may be in the custodians or the brokerage firms. Try to go through some stocks like the mutual funds, BlackRock, and some of the other mutual fund companies. They're getting crushed, and they're getting crushed for a reason, because there's going to be outflows of assets. And guess what? They're not going to come back very soon. This is a major confidence hit to not only the economy, but to the investment arena, everything. This is a game changer. I will be in future videos going sometime in the next several weeks. It's really not that important to come out with it today, because we haven't. People are asking me earlier on the broadcast, do you think where's the bottom? Where's the trading range going to be? There's no way to tell. And I'll go through that. I'll unpack that. We go into the technicals. Let's go ahead and start on that now. We'll start off by looking at the futures. There's actually nothing to look at. But what I do want you to see, and this is very similar, this is deja vu to last Sunday night, is we're seeing 5,915 sell orders at limit down. Where this flat line is the maximum that they allow the futures to decline in the evening session. Opening at these levels may be even worse. There's 6,000 to sell, and I think I figured out last week that's close to $750 billion worth of stock to sell. So there's a ton of money looking to sell this. They've managed to trade 6,766 contracts at this level. My guess is that all of these contracts that were traded were market participants that were short, and they're buying back, just taking some profits. How things are going to open. We're still several hours away from London opening up. Asian markets have been kind of all over the place when I looked at them earlier, so there's not a lot to key off of. But we're limit down, probably going to hit circuit breakers right off the bat in the morning, and it could get very ugly. We could be very quickly back to the lows that we saw last week. Expect lots of volatility. Everybody from the Trump administration, Mnuchin, Larry Kudlow, all of these people are going to be out as surrogates trying to calm these markets down. And I believe everything they say will make it worse. They're better off just to leave it alone, I think, but that's an opinion. So looking at the S&P cash here, there's a number of things that are going to be interesting. We saw this huge rally back on Friday. It was like massive short covering. But what you didn't see is right after the close of the cash, all you saw is this, if you aren't watching the futures, and you saw them up 9.29%. Well, the futures dropped about almost 3% in the next 15 minutes after the cash closed. So we were already due to open 400 lower. I'm looking at the Dow Jones futures right now down 1,000. Well, they're actually more like 1,400 down. It's going to be ugly, but the bottom line is this is not over. And the best thing that can happen here is that we get down toward the lows and we hold and we see some stability. The market's got to find that point that it's satisfied with as it being an extreme valuation. And I don't believe we're there yet. I think we still could go to around 2,400, maybe even 2,200. Let's take a look at the intermediate charts. When we look at the intermediate charts, the S&P was able to rally back and close back above the 200-week moving average, which was certainly encouraging until the Fed panicked and they set the tone for banking crisis, illiquidity, all other types of anxiety and concerns. And this is what I was talking about earlier in the show when I was talking about these shock waves that are hitting. So this will be another shock wave. We'll see if we can hold the lows. But if we look at the range possibilities on a weekly basis, it appears that there's some key numbers around 2630 and then again at 2537. Below that, we could go all the way down to 2363, and that starts to print some numbers like what we saw back in 2018. So all of a sudden, the clock's been turned back to 2018. The entire rally has been removed that we had over the last couple years. I discussed this on the video for Friday, and this is the monthly graph. And what we're seeing here is the charts have turned around completely, and the possibilities are going us down to this 200-month moving average, which is 1690, which will be similar to the highs that we had in 2000 and 2008. They're around 1570, so somewhere between 1620 and 1570 is where we're likely to go here. So this is going to get a lot worse. I've said this a number of times that we're not going straight there, but anything's possible the way things are going. If market participants start to actually get ultra concerned about the impact on the U.S. economy, then that's going to be a problem. You're looking at the VIX at 57.83, and if you understand what the VIX is actually projecting out what the next expectations for the market's downside for the next 12 months. So they're saying the market could be down basically 60%. Certainly could be the case because we don't know how long these cash flows and sectors of the economy are going to be shut down. There's no way to estimate this. Absolutely no way. But expect what I said earlier in the show is that there's going to be multiple shock waves, and every time this thing looks like it's at a bottom, there'll be another shock wave, self-fulfilling. There'll be another bit of information that comes out over the next several quarters about what has occurred from these dislocations of capital. So before we move out of stocks, let's take a look at a couple of these mutual fund companies as well as some of the custodian stocks. So let's start off by looking at Invesco, which is basically a has-been investment management company. They are most likely, if you look at this stock, this thing is getting tanked. It was just in 18 was all the way up to around 35, 37. It's now at 1080. This thing is going to be under major pressure going forward financially, and they're going to see an outflow of funds. All the companies I'm going to put up here right now are going to see a massive outflow of funds, and the money's not coming back. Next company is BlackRock. We can see it has collapsed substantially. We're getting close down to the 2019 lows, 2018-19 lows, and this stock is also going to continue to go down. They've got a big footprint in ETFs, which has been a booming market for several years. And that in itself, what's gone on in ETFs, should have been a warning signal to everyone. Everybody is setting up ETFs. I saw like 5 weeks ago, there was a group on CNBC, and they were so proud they got a brand new managed ETF. I bet they haven't got very much money into that fund. Let's just take a quick glance of some of these stocks with Bank of America here that's on the screen. This stock is down substantially. We're a long ways from getting into crisis levels like we were in 2009 and 11. But we have taken out some significant lows. But what's happening here, and I'm going to show this to you on all these charts, these are going to be monthly secular long-term viewpoints, as all of these trends have turned negative. We got minus 0.80, minus 0.65 on the trend here. Let's take a look at Goldman's similar pattern. And what I want you to see is there are all these steep downward patterns. Most of them are taking out the 2018-19 lows that occurred in the financial sector. These things are not going to recover anytime soon. Another custodian to look at fairly closely is LPLA, one of the bigger independent operations with independent advisors. Just got crushed. My expectations is that ultimately it will get back to somewhere between 35 and 25. Possibly then there'll be some stability. All of the financials have retreated and are taking out lows, previous lows from the last decline. Looking at the Treasury market, we saw this huge reversal go all the way from 0.495 back to the 0.95 level. So basically almost a double in interest rates. And this is a big move. You have to remember the Treasury market's 30 times bigger than the equity markets when it comes to money being moved. Been a Fed watcher forever and ever. Never seen the Federal Reserve take off all reserve requirements. Never seen that happen. Early in 1980, Paul Volcker actually increased the reserve requirements. They spiked the rates trying to break inflation at the time. It was right after the Carter administration and massive inflation that had built up, starting going way back to the Nixon administration. So it was 8 years of inflation that had built up. But this is total different situation when we see this. And the amount of money that is in treasuries is huge. But this is a big move. And this is most likely what you're seeing here on this weekly chart is a major spike in yields. And he's going to consolidate down here. There's still a lot of downside pressure. It's going to take a number of weeks for that to burn off. 1.04 is going to be the top end, so just a touch over 1%. So probably 0.5 to 1%, depending on what happens in the marketplace, we could test the 0.49. It's just okay to be in cash and not have any involvement until you see some stability, whatever market is able to stabilize and then start to bleed over into other segments and asset classes that will ultimately lead to stability and a bottom of this market. We're a long ways from that moment. Let's take a look at the yield curve. And I've got this spread out so you can see it. You can see all the yields spiked up pretty substantially. There's no inversion. There was a moment of inversion, but it didn't last long. Now what you're going to see when the 13-week, you're going to see this thing just collapse down toward zero. You're going to get down to probably 0.25. Fed will be buying mostly T-bills, but they're going to be looking at all maturities. $6-7 trillion Fed balance sheet here. This is going to get really interesting and I think really scary. The dollar is going to be one of the more interesting markets to watch. It's down 1.34% right now. This is going to lead us to understanding more about what's going on with the treasuries as well. Fed's viewpoint, they have actually given a lot of power to 5 central banks. So they made a deal today. One of the other things they did was make a deal for ECB will have the ability which to supply dollars when things are getting out of whack, because we could have a dislocation demand on dollars or selling of dollars that could really skew the entire deal across the board. Tell you there will be open lines between all of the major central banks, Japan, US, EU, Bank of England, Swiss Bank. There's a lot of money that flows through Switzerland. It's still a very big banking industry. It's going to be intense. Taking a look at gold, I wanted to start with this weekly chart because a bunch of folks are getting excited about the move in gold. It's up 1.47% right now. It's back to 1538, but it's way down in the hole. It declined. It declined down to the 1502 level. It's back at 1539, but when you look at this weekly chart, you can see we had this massive reversal pattern. All of the PPMs, all the momentum is gone out of this market. So rallies, if it gets lucky, back to 1580, maybe as high as 1600. What we're seeing right now is an inside bar which is pretty typical after a big down move like we saw on Friday. This will most likely consolidate over the next couple of days. There's much more downside. Expectations for volatility today are, and as I've talked about before, like why isn't gold moving more with all this going on? It's one of the assets. Everybody's selling anything and everything to raise capital right now. This will likely continue the crude oil market, but this is setting up a nice pattern. I still believe that we're going to see somewhere above $40, possibly getting up to $44 over the next several weeks. This price is not likely to collapse. However, I'm going to hedge myself. These patterns are still very negative. There's a lot of downside action here. We're likely to see the pressure stay on, but if we hold that $35 level, we should see a bounce up and more stability and start to move up toward that red line, which is the 10-day moving average. The weekly charts just tell the same story, only a little more dramatic looking in this decline. You see that we had the gap, but that gap is still there. We're experiencing an inside session right now. Usually you get an inside bar that will start the pattern to set up some stability. If it goes through 35, then the next level is down at 31, as low as 28. I don't see that happening right now, but this is a market that could influence all the other markets if we start to get really a lot of pressure down here, mainly because of the U.S. oil industry being as big as they are, in spite of the president making, I think, a very strategic move to come in here and fill up all the strategic oil reserves, buying oil from our own people and filling up everything. And as he pointed out, it's going to help everyone, but it's also, if you're looking to buy and store the kind of oil that the U.S. is capable of storing, this is a really good time to do it. So this will complete this broadcast. I will continue to do these every night this coming week. So make sure you hit the subscribe button, hit the bell, and make sure you share these videos. Thanks for watching.